Mortgage stress is falling. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee. We're going to have a look at an article from Mortgage Business. Well, looking at data from Roy Morgan saying mortgage stress has diminished. So it's falling. Now before we have a look at that, let's just talk about mortgage stress, everyone. Now, I'm just going to bring up a definition. The first one will be, I'll bring this up here, is the definition for housing stress. Now, it's typically described as low-income households that spend 30% of their gross income on housing costs. Now, notice here how the emphasis on low income. So what is low income? So low income household refers to 18% of households at the lowest equalized disposable household income quintile, adjusted to exclude first and second percentiles. Now, what does that mean? What does equalized mean? Okay, that's an important thing, and we're going to look at this one as well. Equalized income is a measure of household income that takes account of the differences in household size and composition, and thus is equalized or made equivalent for all household sizes and compositions. It is used for the calculation of poverty and social exclusion indicators. So what is low income in Australia? What's the actual chart here? Now, I'm going to get my shot of coffee here because, this is not good. So here we have the chart. Hang on, I'll turn off this definition. So this is the real mean weekly EDHI, which is the equalized disposable household income by income group. Now at the top we have the high income group, and I'm looking over here at the table on my other screen. We're seeing $2,142 at the top. That's high income. Middle income, and remember this is the mean weekly income, is $902 per week. This is household. Now, adjusted lowest income, $433, everyone. 433, and this is the latest data I could get from the Australian Bureau of Statistics. Household. So you can see why someone who's, on a good caper, over $2,000, paying 30% of their income, may be at a different stress level to someone who's on the lowest income. And this is why we're seeing this K-shaped recovery here in Australia. This is why we're seeing people who are in property are just having no problems, just shooting ahead, and why others are struggling. This is why Australia is it's a two-speed economy, guys. And yesterday I did a video, last one I released, and it was looking at just the differences in generations. That Gen X, they're the amount of money they're paying for a mortgage is about 26% of their gross income. So a Gen Xer on lowest income, for the average, is already nearly in mortgage stress. Where previous generations, the boomers, the silent generations, they didn't have those issues, guys. As a percentage of their income, it was much lower. So, Australia's just not doing it right with regards to housing, guys, and the burden it's placing on generations, sinking us into huge amounts of debt too for the future. It isn't filling anyone with any confidence. So let's have a look at this one. So mortgage stress is declined in May, according to Roy Morgan. Mortgage stress diminished in the 3 months to May, but the latest COVID-19 flare-ups have renewed fears that could change, according to Roy Morgan. Research from Roy Morgan has shown that an estimated 677,000 mortgage holders, 17.3%, were at risk of mortgage stress in the 3 months to May 2021. Now, here's the thing. If they're using the definition of mortgage stress as only those similar to the housing stress from the ABS, where it's only those that are in the lowest income, that are worried about their 30%, or if they're using everyone for the 30%, you're going to get different indicators of stress. One will all be going, so many people are at stress and most people don't care. I guarantee you there are people watching this right now who are probably paying 30% or more on their mortgage, and they're just used to it. It's not going to make a big impact to them. Well, there are other people who are at the lowest income, low income houses, who are paying less than 30%, but are at severe mortgage stress. So, meaning their mortgage repayments are greater than 25 to 45% of their household income, depending on income and spending. Okay, so they're using a different definition here. 25 to 45%, that's just an insane range. If you're spending nearly half of your money of your household income on your housing, well, of course you're going to be in housing stress. Over half of those borrowers, 11.8%, roughly 440,000 people, were considered extremely at risk when even their interest only is over a certain proportion of household income. The proportion has declined year on year from 794,000 mortgage holders, 19.4%, being at risk during the early stages of the pandemic during the 3 months to May 2020. Roy Morgan stated that the May period this year encompassed the end of the JobKeeper wage subsidy, low community transmission of COVID-19, and only a few short and sharp lockdowns and border closures. Improved employment conditions in the first half of 2021 and the support measures taken by banks such as financial distress mortgage holidays alongside record low interest rates were also cited for the decrease in mortgage stress, despite the level of financial support tapering off. Michelle Levin, chief executive of Roy Morgan, commented that contrary to fears around the beginning of the pandemic, government and bank support has led to a sustained period of low mortgage stress. The latest outbreaks of COVID-19 in Sydney and Melbourne are causing renewed concern as hundreds of thousands of workers in both cities are forced to stop working as part of the lockdowns across industries such as retail, hospitality, recreation, and in Sydney, the construction industry. The good news is that one of the lessons of the pandemic to provide financial support to those forced into financial distress by lockdowns has been learned, with both federal and state governments increasing the level of new financial support available in both states this week. Roy Morgan has also tracked employment amid the pandemic, recording a change in circumstances for 72% of Australians, 11.2 million in May 2020. In June this year, employment circumstances had changed as a result of the virus for an estimated 9.6 million. Many of the employment changes were negative and included having working hours reduced, a slowdown in offers to work, being stood down, a slowing or complete halt in business, being made redundant and having reduced pay. For those with negative employment changes due to COVID, mortgage stress was higher. Well, that makes a lot of sense. Close to a fifth, 19.9% of those who had been impacted, employment had mortgage stress in the 3 months to May, 2 months more than the overall average. Of the groups at risk, 14.7% were extremely at risk. The number of mortgage holders considered extremely at risk had dropped from an initial spike as the pandemic began until it plunged to a low of 11% overall in the 3 months to October. Now, I mean, this is the thing. They're saying we're extremely at risk, but then we're getting data from the RBA where we're seeing, housing loans and negative equity has just been falling for years. You've got housing loan prepayments. People are ahead. Look at how that's gone up. Nearly 20% of housing. So even if you're at the potential of mortgage stress, there are going to be people that are ahead on their mortgage. There are going to be people that are not like the ABC article, that didn't need the mortgage holidays, but took them just to build up a cash reserve. Honestly, I'm tempted to take one and go interest only for a year, just for the sake of it, because money's so cheap, and then invest that money in shares, because then I'd be equivalent, borrowing 2% off my mortgage to do it. But I don't know. We'll see. It's probably way more effort than I could be bothered doing. It's a bit different than calling the bank. Here you've got household liquidity buffers. Indebted homeowners have got months. Renters have got months ahead. So, and here, liquidity and debt. So you've got to see when we're reading this based on the Roy Morgan data, we're getting different information coming at us from different sources. So the danger is to just obsess about the doom and the gloom because it gets the clicks. That's what can happen to here, guys. So, however, as government support was progressively withdrawn and mortgage holidays began to end, it rebounded and hit a peak of 13.7% in January, covering 526,000 in the 3 months to January. But, How many houses have actually been foreclosed through all of this? And AB said none. Just think about that. Many years of research into mortgage stress has shown the biggest driver of increased mortgage stress is the reduction in income caused by the loss of jobs, which causes an immediate jump into a risk category, she said. Over 2 in 3 mortgages rely on more than one income, and our analysis shows losing even the lower of the 2 incomes causes an immediate 4-fold increase in the likelihood of those mortgage holders becoming at risk or extremely at risk. Yeah, okay, but even if you've got 2 incomes, that means you can still make do. It's better than having one. You want to have a diversity of income sources. You don't want your husband and wife team working in the same industry or same sector. If you're in different ones, that can make do. So mortgage at stress, I don't know, guys. I'm thinking more and more that a lot of this, until we start seeing people actually falling over and forced sales occurring, which the banks have said they're not going to happen until next year, we've seen the government not opposed at all to intervening in the market, to propping people up and to helping them out. Future generations may take a burden. So we'll have to see. If those of you that are waiting for a bargain to appear as people are forced to sell out, can you see it happening? Can you see the political will to allow that to manifest here in Australia? Anyway, what's the solution to this? Have a diversity of income sources. Prepare yourself. Build up a cash reserve. Get ahead on your mortgage if you're in potential stress. The best solution is to increase your income. To be quite frank, is to increase your income so you're not sitting at the lowest income level. You need to try and pull it up. I know that's easier said than done, but that's the real solution. Bloody hell, 433 a week, guys. This shows you. Look at this chart. Look at the difference between the high income and the low income. And you're not talking like billionaires and millionaires in the media, like the Reinhardts. Sure, they're going to have an impact. You're talking people working in mining as opposed to people working in retail. That's what we're seeing in this chart right here. And who do you think is going to cop it harder because of the lockdowns? Going to cop the burden, going to lose years of potential earning and capacity to build up and save for their retirement or to build their life. Those that can least afford it. Is it worth it? Anyway, guys, thank you all for watching. Please like, share, and subscribe to the channel. Let me know your thoughts and opinions on this one in the comments down below. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. Sign up for SelfWealth or Stake. Use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. Buy a merch from HeiseSays. You can see the lovely pocket squares here. Use Gold Pass from the Perth Mint or support us via PayPal. Take care, guys. I'll see you next time. Bye for now.